estate partnerships. They can be excellent vehicles for acquiring an investment property, especially property that might otherwise be beyond your resources to purchase. But how do partnerships work? How might they be structured? There are different kinds of partnership structures, and there are many variations on how you might choose to divvy up the economic benefits among the partners. I discuss these topics, with examples, in my online video course, An Introduction to Real Estate Investment Analysis. You can find out more about the course, including a complete syllabus, at learn.realdata.com. I invite you now to watch a brief excerpt from the lesson where I cover preferred return and waterfall structures. I hope you find it interesting, and I hope to see you in class. What else can they do to structure the splits so that everyone gets a reasonable share of the pie? A structure where the managing partner, who's doing all the work, gets a return that is greater than the other investors, but not so great that it makes the deal not worthwhile for those others. Well, a very common device is something called a preferred return. And you can see that option shown here. In short, it works like this. The partners agree that the non-managing members, or limited partners in a limited partnership, are entitled to a specified cash return on their investment before the managing member or general partner receives anything. We're speaking here of an annual cash return on cash invested, not the property's internal rate of return. So if a partner invested $1 million in the deal, and the preferred return were 10%, that partner would be entitled to $100,000 per year from the cash flow. And then the remaining cash flow, if any, would be divided up according to the agreed upon splits. But what if there isn't enough cash flow to pay the entire preferred return? Then the unpaid amount would be carried forward as an arrearage and get paid in whatever year there is enough cash. And if there is still an arrearage due when the property is sold, then that gets paid out to the non-managing members first, paid out of the sale proceeds. And then the remaining cash from the sale is divided up as agreed. So our partners decide to give this approach a try, and they agree that 7% would be a suitable preferred return. How do things look now? As we can see, the 5-year IRR for the non-managing members moves up to 11.04%. And Alice, our managing member, is down to 15.48%. Now it's Alice who's feeling a bit shortchanged. She doesn't think this differential adequately recognizes her efforts, and she suggests that perhaps she ought to get a little performance bonus if she does an especially profitable job operating the property over the long haul. That's something we can accomplish with what's called waterfalls. To put it simply, waterfalls are a cascading series of hurdle rates, IRR hurdles typically, and as the property's performance clears each hurdle, the promoter, aka the managing member or general partner, gets a bigger piece of the pie.